$47 billion valuation, unraveled before the IPO. In 2019, WeWork prepared to enter public markets after nearly a decade of expansion, operating in more than 100 cities with hundreds of locations, and a business model that appeared on presentation slides to combine real estate, technology, and community. The company's governance structure centered on Adam Neumann, who held both the chief executive role and outsized voting control through a multi-class share structure. Revenues were growing, losses were expanding. The system functioned because capital remained available. Board meetings followed a familiar cadence. Growth targets dominated agendas. Lease commitments accumulated as the company signed long-term obligations while offering customers short-term flexibility. Analysts described the firm using multiple categories depending on audience: technology platform, lifestyle brand, commercial landlord. The classification mattered less while funding rounds continued to close at higher valuations. Capital markets were receptive. Credit remained cheap. Early investors justified continuity through metrics that prioritized top-line expansion, location count, and membership growth. Incentive structures aligned compensation with scale rather than profitability. The logic was consistent with venture-backed growth models. One procedural irregularity, noted but not initially destabilizing, involved related party transactions between the chief executive and the company itself. The disclosures existed. Their interpretation varied. Within governance materials, Newman's personal ownership of properties leased back to WeWork was presented as alignment, founder conviction embedded in real assets. Alternative readings framed the arrangement as risk concentration. Both interpretations coexisted because performance data supported expansion narratives. Occupancy rates appeared robust. Demand projections remained optimistic. Debt providers continued participation. The company's evolution into the We Company formalized a structural shift. Branding expanded beyond shared office space into residential concepts, education initiatives, and ancillary ventures. The reclassification broadened strategic scope without proportionally altering operating economics. Revenue streams remained largely tied to workspace memberships. Lease liabilities continued to lengthen in duration. External pressure emerged gradually. Public market comparables imposed different evaluation frameworks than private funding rounds. Profitability timelines, unit economics, and governance transparency gained prominence. Preparations for the IPO required detailed disclosures through the S-1 filing. Information that had circulated within investor briefings entered standardized documentation. Context narrowed. The filing revealed financial asymmetries embedded in the model. Long-term lease obligations contrasted with short-term revenue commitments. Losses widened despite scale. Adjusted metrics introduced alternative profitability narratives. Observers encountered competing descriptions of the same numbers: growth investment versus structural imbalance. Interpretation diverged by stakeholder. Advisors increased engagement frequency. Underwriters, including J.P. Morgan Chase and Goldman Sachs, expanded review processes as valuation assumptions encountered public scrutiny. Meetings multiplied. Language tightened. Market feedback loops accelerated. Deferred agenda items began to cluster around governance provisions rather than expansion targets. 3 procedural adjustments surfaced in sequence. The chief executive agreed to reduce supervoting control. Personal transactions became focal points for revision. Compensation structures entered renegotiation. Each adjustment appeared incremental. Collectively, they reframed authority distribution within the organization. The accommodations narrowed future options. The valuation range shifted downward as institutional investors recalibrated expectations. Comparisons to real estate firms gained traction. Growth multiples compressed. The same operational data now traveled through different analytical filters. What previously justified expansion began to justify caution. The narrative velocity changed direction. Within weeks, internal interpretations and external reactions diverged sharply. Inside the company, adjustments were framed as transitional recalibrations consistent with IPO preparation. Outside, revisions signaled instability. Media coverage simplified complexity into leadership-focused explanations. Governance mechanisms became secondary to personality narratives. Liquidity constraints emerged as a direct consequence of valuation compression. Expansion strategies had assumed continued capital access at prior pricing levels. Lease commitments, once viewed as assets enabling scale, functioned as fixed obligations under reduced funding scenarios. Financial flexibility contracted without formal declaration. The board initiated additional review layers. Independent committees assessed governance structures. External counsel participation expanded. Meeting agendas shifted from growth trajectories to continuity safeguards. Authority flows became procedural rather than executive-driven. Decisions required broader alignment across oversight bodies. A timeline compression followed. What had been framed as a multi-quarter transition condensed into immediate structural deliberations. Debt facilities required reassessment. Planned secondary offerings encountered revised conditions. The IPO itself moved from strategic milestone to contingent event dependent on stabilization measures. Investor reactions reflected competing constraints. Major backer SoftBank evaluated exposure through portfolio-level considerations, balancing capital preservation with reputational implications. Funding alternatives narrowed. Bridge financing discussions accelerated. Each scenario introduced trade-offs between valuation acceptance and operational restructuring. Masayoshi Son engaged directly as capital commitments transformed into governance negotiations. Proposed rescue packages tied funding to leadership changes and structural revisions. Stability required reconfiguration. Continuity became conditional. The mechanisms were financial. The consequences organizational. Newman's role entered formal reassessment. Negotiations addressed voting rights, compensation, and transition frameworks. Public communications emphasized alignment and evolution. Internally, the deliberations centered on restoring market confidence under tightening timelines. The distinction between voluntary adjustment and forced accommodation blurred procedurally. The leadership transition unfolded not as a single decision but as a sequence under constraint. Voting control modifications preceded executive departure. Compensation arrangements followed authority redistribution. The office itself remained. Its occupant changed. Governance mechanics drove the outcome. Withdrawing the IPO filing formalized a structural pivot. Expansion targets were suspended. Workforce reductions commenced across global locations. Visual markers reflected the shift. Emptied offices, halted construction, signage removals. Operational contraction replaced growth acceleration. Lease renegotiations entered priority status. External narratives stabilized around valuation collapse. Internal processes focused on liquidity management, cost realignment, and asset optimization. The same events supported divergent interpretations. Failed technology unicorn versus leveraged real estate operator adjusting to market discipline. Both readings persisted. Debt obligations constrained restructuring pathways. Lease liabilities required negotiation with landlords across jurisdictions. Financial engineering replaced expansion engineering. Performance reviews highlighted metric misalignments embedded in earlier incentive frameworks. Profitability assumptions entered recalibration without immediate resolution. SoftBank's subsequent capital injections altered survival probabilities without erasing structural tensions. Funding stabilized short-term operations. Governance provisions tightened oversight mechanisms. Authority dispersion increased. Decision velocity slowed as review layers multiplied. Stability traded against flexibility. Market conditions compounded constraints. The emergence of remote work dynamics reduced demand for shared office space, introducing exogenous pressure unrelated to governance architecture, yet deeply consequential for operating economics. Occupancy projections required revision. Portfolio utilization shifted. Management frameworks adjusted accordingly. Asset divestitures, location closures, and cost rationalizations became procedural norms. The organizational logic transitioned from expansion under capital abundance to preservation under capital discipline. Incentive structures aligned with sustainability metrics rather than scale metrics. The headquarters environment reflected continuity amid redefinition. The brand remained visible. The org chart evolved. External observers recalibrated classifications once more. Turnaround candidate, distressed asset, stabilized operator. Each label implied distinct valuation logics. None eliminated uncertainty. Governance documents codified revised authority structures. Voting controls normalized. Related party transaction policies tightened. Oversight mechanisms expanded committee mandates. The system that had enabled concentrated decision-making now prioritized distributed review. Efficiency metrics adjusted to reflect procedural density. Performance indicators stabilized unevenly. Revenues contracted before gradual recovery. Losses narrowed under cost reductions. Lease portfolios shrank. The operating model persisted in modified form. Expansion narratives yielded to optimization narratives. Scale ceased functioning as primary justification. External comparisons shifted from high-growth technology firms to hybrid real estate service operators. Analytical frameworks stabilized around cash flow visibility, liability management, and utilization rates. The interpretive environment changed without altering the physical assets themselves. Leadership discourse receded from central explanatory status. Governance mechanisms, capital structures, and market classifications assumed greater analytical prominence. The organizational trajectory reflected interactions between financial constraints and procedural adjustments rather than singular executive decisions. The file documented successive reframings. Valuation expansion justified governance concentration. Disclosure standardization reframed valuation assumptions. Market feedback accelerated governance redistribution. Liquidity constraints necessitated leadership transition. External shocks reshaped operating economics. Each phase emerged from preceding conditions. WeWork continued operations under altered premises. Locations reopened. Membership models adapted. Capital providers recalibrated expectations. Governance frameworks remained tight. Strategic ambiguity persisted regarding the firm's categorical identity, technology-enabled platform or flexible real estate operator. The valuation collapse did not erase the underlying demand for workspace flexibility, nor did subsequent stabilization erase the structural tensions inherent in lease duration asymmetries. The model endured through modification rather than replacement. Continuity and change coexisted operationally.